So the penultimate session of the day, we're going to be talking about trust and specifically how the pandemic has affected public trust in financial services. We're joined by Andrew Wilde from Edelman, which is the communications boutique, to present the latest result from the Edelman Trust Barometer. So welcome, Andrew.
Hello.
Hello, there you are. Hello. So I know you've been specialised in the financial services team within Edelman, and you've been in that space for the last 15 years or so. I will let you get to your presentation very soon, but I just had one burning question, which is that do you think trust in financial services has fundamentally shifted in those last 15 years that you've been in the space? I feel like obviously we had the crash, but ultimately at the moment we do still trust banks on the whole. I would say we just don't like them very much. Is that accurate, or has there been a shift?
Yeah, there definitely has, and I think it's a fairly obvious point. But as the shadow of the financial crisis receded and the economy started to recover, people started to, in your words, sort of dislike the banks a little bit less, because their villainy was seen as something of a sin of the past. And I think at the moment, and one of the things I'll touch on is, at times of kind of crisis, which aren't caused by the banks, people gravitate towards them because they give a sense of security. They're big, they're established. And in a sense, they're on the kind of if there is such a thing, the economic front line of the economic crisis that we're experiencing at the moment. So trust has recovered, and I think there's been a massive trust spike in the banks because they're really, really important right now.
Absolutely. Okay, well, I'll hand over to you to share your presentation then on public trust in financial services as it has been.
So first of all, thanks for having me. Edelman is the world's largest communications firm, and through its annual trust barometer, we've monitored the levels of trust in governments, business, the media, and NGOs for 20 years. The Trust Barometer is a poll of 33,000 people in countries all over the world, and it's become a reference point for governments and for businesses and for policymakers internationally. It's usually done annually, and we launch it every year at Davos. But obviously this year it's a year like no other. And just as COVID-19's changed pretty much everything for everyone in business and in life, it's changed the dynamics of trust. So we've done a sort of a special COVID update in May with a smaller sample size, 13,000 or so, in 11 different countries that we thought would be representative. So the data that I'll touch on is drawn from there. And what I've done is I've endeavoured to isolate a few trends that I thought are particularly relevant for FS companies looking to scale up in the UK. So if anyone can hear me, I'll be going on to the next slide. But after a long preamble about trust and the Trust Barometer, I was actually going to start with something from one of my clients, not Edelman. This data is from EY. And I just thought it'd be useful for context. EY releases an annual study about attractiveness into the FS sector as measured by the level of FDI. And they released the last one last month. And you'll see that despite the Brexit risks, the UK has a dominant share of FDI projects in Europe. More than a quarter of all FDI projects are in the UK. That's the graph on your left-hand side of your screen. And the UK, for context, has got more inbound investments in 2019 into financial services than France and Germany combined. And what's more, investors think that the situation could get even better. So 40% of investors said that UK financial services will become even more attractive in the 3 years post-COVID. Despite the crisis, the outlook, according to a lot of investors, is good, and that compares to 8% who say the same of the rest of Europe. So I guess my key takeout here is, in spite of Brexit and COVID, the UK is kind of the place to be as an FS company looking to scale up and attract investment. But turning to the trust barometer data, what this graph shows is that trust globally is on an upward trajectory. Isabel mentioned before that it wasn't always thus. In the years following the crisis, only 40-odd% of people said that they trust financial services companies, and there were fairly obvious reasons for that. But that stands at 64% today, including a particularly sharp spike between January and May this year. And if we just skip over and look at trust in UK financial services specifically, you'll see a 9-point rise in the level of the number of people, the percentage of people who say that they trust financial services businesses. A 9-point rise between January and May, and that's very, very steep in the historical sort of context of the trust barometer. And the reason for that trust spike is that in times of crisis, we found over the years, people sort of rally around their institutions. Incidentally, trusting government has also spiked, not just here, but in the US, pretty much all over the world. And people gravitate towards the institutions that they believe are going to protect them at a time when they really, really need them. Because as I mentioned, as well as a healthcare crisis, it's an economic crisis, and people appreciate how important the banks, the insurers, the fintechs are in their effort to kind of get out of the market. But so if the picture for trust looks good, what does that actually mean for companies for FS companies in this country? What opportunities does it unlock? And I thought I'd just touch on two, because there are obviously many ways that being a trusted company can help you. The first one is open banking, and I know that you've spoken a bit about it this morning. But I thought it was interesting because open banking, I think most people would say, has been a bit of a slow road due to people's reluctance to share their data. And I think COVID-19 could be a real game changer here, because as the chart on the left shows, people are becoming more and more comfortable with the idea that their data can be used for good. And people are more willing to share that data with trusted sources. So if there is a read across, if we've reached a moment in time where people are more comfortable with that, it should, it stands to reason it should kickstart open banking. The second trend is that evidence is really pointing towards companies engaging an awful lot more with the brands that they use. People are saying it's more important than ever to them that the companies that they use, their bank, their credit card provider, their platform, whatever it may be, will do right by them. And they're thinking about that more. And during a crisis time, when people feel vulnerable, perhaps, they want to know that the companies that they use have their best interests at heart. And to us, that represents a massive opportunity to financial services companies in this country who can deliver on their promise to customers and can actively demonstrate that they're on the side of their customer base. So that's all very positive. Trust is up. Everyone's a big fan of FS at the moment, but there is a but. There always is a but. And the but is that in previous years, when we've seen trust spikes, the following year, we've almost always seen a trust crash. So people gravitate towards their institutions, they invest a lot of faith in them, and either they feel let down afterwards, or their expectations of these institutions are so high that it's hard to deliver against what they, what customers and consumers expect of you. So there is a word of warning there. And just sort of turning over to what might drive a trust decline, we try to probe this a little bit, and we try to identify the pain points where people feel that perhaps companies are failing. And And we thought that these might be the potential lead indicators of a possible trust collapse for certain companies. And I've identified four, three on this slide. Like less than 4 in 10 think that companies are putting people before profits. Similar number think that they're protracting their employees' financial well-being. Apologies about the stray apostrophe there. That's terrible. The grammar police will be on me very soon, I think. And a similar number think that companies are actually helping their supply chain and smaller businesses by extending credit, by giving them flexibility. There are areas where companies and financial services companies are seen to be failing already. And the next area is just on the next page. Yeah. This is a bit of a complicated chart, so let me just explain it. You've got all the sectors there along the bottom, and you've got what companies say is important to them in the black bar chart, and how well they're delivering against this in the white bar. So we've asked, are companies offering easy and affordable access to the products and services they need? For financial services, that's hugely important. 70% of people say it's important. Only 51% of people say that FS companies are actually doing that. So there is a 19-point gap between kind of expectation and delivery, and that is the widest gap of any sector. So again, we think that this might be a bit of a lead indicator for next year, an area where companies need to pay particular attention if they're looking to attract customers, attract investment, and so on. And then finally, this is my sort of final slide. I think it's worth noting that the actions of a single company or a single individual can have a disproportionate effect on a sector as a whole, and we've seen this in previous years. So back in 2016, around the time the Brexit referendum, when the concept of fake news really sort of entered the public consciousness, we saw a trust decline in the hitherto beloved tech sector. They weren't seen to be doing enough about that. I think at the moment they're going to have a problem as well. We can see with their advertisers around Black Lives Matter not doing enough for racial equality. The Weinstein saga had a huge effect on the entertainment industry. A trust collapse ensued there, and a similar picture in autos in the emissions scandal. And at the moment, I've got to be a little bit careful what I say here, because colleagues in other markets within Edelman have actually worked for the company I'm alluding to previously, I should say, not now. But there is a large German company in the fintech space that is undergoing a scandal, and when these major scandals happen, people have to pedal harder to avoid being tarred with the same brush. And there's no single right way to pedal harder in our view. I mean, clearly every company is different, but I'll leave you with a thought. And that thought is, when we looked at the individual traits, the individual behaviors which people said led them to trust a company more, we were able to bucket them really in two categories. One, kind of competence, but did they do what they were supposed to do? And two, ethics. And did they do right by their customers? Did they advocate for the right sort of values and so on? And we found that at the moment, ethics, the ethical drivers, are 3 times more prominent, 3 times more important than competence. And it's not saying that it's good to be incompetent, but the things that really pull people towards a company are sort of sit under the ethical category. And so it's not just enough. It's not enough to just not commit fraud, or not do the terrible things that Weinstein did, or not perpetuate untruths. But customers are looking for people to advocate for them, to espouse their values, to champion the things that matters to them. And in our view, if you can do that, at the moment, you'll maintain the trust boom that we're undergoing, and you'll be able to capitalize on it.
Thank you, Andrew. That was genuinely very interesting. I just wondered if you could hammer home one point, which is, when we talk about financial services, I assume that encompasses both banks and fintechs. Is there any distinction that you've seen in the trust trajectory of fintechs in the last kind of, well, basically the 5 years that it's existed or so?
Yeah, well, it's sort of, well, as the name suggests, it's a kind of it's a composite of what happens in financials and tech. I mean, we do look at fintech, but it sort of plows a furrow in the middle, and it's currently experiencing the tailwinds of financials, that people really need them, and the headwinds of tech that actually, after years and years and years of being beloved by consumers and also by investors, there are now questions around regulation. There's now questions of systemic importance, questions about how much they're championing racial equality and doing enough to clamp down on fake news. And I think fintechs kind of benefits and suffers in equal measure from both.
Yeah, and overall, would you say that this trust spike that we're seeing? Do you expect that fintechs will suffer in the same way that what you've said will be the trajectory suggests a big trust loss?
I mean, I think yes, because we've seen it historically. I think rather than saying they'll suffer, I'd say that they need to be on their guard for it, because and when an expectation level, an elevated expectation level is set,
yeah,
you then have to deliver against it. And I think you've got a higher bar to jump over, and at the same time you've got the other issue that I alluded to, which I think it casts a big shadow over a sector as a whole. And I think it's, as I said, it's incumbent on companies not only to kind of avoid wrongdoing, but to actively do more to show that they are on the side of the angels and the angel investors.
Yeah, exactly. No, that's so helpful. Thank you so much, Andrew. I'll let you go back to, I'm sure, a long list of clients ready to tap into your brain. But thank you so much, and speak soon.
Thanks very much. Bye-bye.